Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 318 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including Fed Week fun facts, the S&P's impressive summer performance, Build-A-Bear's surprising stock strength, the importance of a wealthy consumer, gold, and how generations rank investments. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. So let's jump in. How are you doing this morning before we get started, Matt?
I'm doing good. Got the big anticipated Fed meeting out of the way yesterday, right? That overhang and concern for the market now leaves. And I think we're in a little bit of no man's land for market news until we get a little deeper into Q3 earnings season.
Right.
So the next couple of weeks, not a significant amount of catalyst, I would argue.
Yeah.
And I'm okay with that.
Yeah, good point. Yeah, we're going to get into the Fed announcement here in a little bit. But before we do that, just going to review the major market indices that investors track. This data is from Y-Charts and as of the market close on September 17th. S&P 500 index up 2.2% so far in September and up 12.2% on the year. The Dow Jones Industrial Average up 1% for the month and up 8.2% for the year. The NASDAQ Composite Index up 3.8% for the month and up 15.3% for the year. The Russell 2000 Small Cap Index up 1.6% for the month and up 8.1% for the year. And the Vanguard All World X United States ETF is up 3.2% for the month and 24.7% for the year. The 3-month Treasury rate at 4.02%, the 2-year Treasury rate at 3.52%, and the 10-year Treasury rate sitting at 4.06%.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
And moving on to big headlines, current events. Matt, you mentioned it already. The Fed did, in fact, cut its target range for the federal funds rate by 25 basis points. So they went from 4.25% to 4.5% down to a range of 4% to 4.25%. So this is the first rate cut since December of last year, which is 2024.
Correct.
And some of the reasoning the Fed gave behind that was that they believe economic growth has moderated in the first half of the year, that job gains have slowed, and that unemployment has nudged up as well. And in the Fed's view, the risks are shifting more from inflationary to employment, right? Which is prompting them to have more caution. So just as a reminder, the Fed has two main objectives, right? Number one is price stability, i.e. having inflation under control. And number two is having full employment, or as close to full employment as they can. So the Fed also signaled that there will likely be 2 more rate cuts this year, which would put the target range at 3.5% to 3.75% before the end of the year. If we do get those 2 additional rate cuts, and each of them are 25 basis points or 0.25%.
That's now become, I think, a solid expectation of the market.
Kind of the standard, if you will. So a couple more fun facts since it was Fed week. Just have a few that we want to share with you all.
This will be fun.
2025 is the third year since 1996 with a rate cut, while the S&P 500 is at record highs. Mm-hmm. Since 1980, the Fed has cut rates 20 times, with the S&P 500 within 2% of an all-time high. Mm-hmm. 100% of rate cuts since 1980, with the S&P 500 at record highs, led to more record highs 12 months later. I think that's a really interesting one, Matt.
It is an interesting stat.
Maybe something that people wouldn't necessarily expect.
Yeah, and again, just because it's happened that way, the last time since 1980, doesn't mean it's guaranteed the market's going to be higher 12 months from now. But it is a key data point. I mean, we talk a lot about some of this historical data, and I think it needs to be, given some credibility.
Yeah.
It's not guaranteed.
Right. Two more for you. The 1996 rate cut with the S&P 500 at all-time highs led to a 22% rally in 12 months. That was near the beginning of the internet and tech boom, and some people are kind of using that analogy of the tech and internet boom to us currently being at the beginning of the AI boom.
I think it's an interesting analogy. I keep seeing people attempt to show charts of popular late 90s tech names like a Cisco and providing a comparison to an NVIDIA. And the correlation works until it doesn't.
Yeah.
And I think, again, it's dangerous, from my opinion, to compare tech companies of the late 90s to tech companies to today. Completely different animals. I won't get on that soapbox today. But it's an interesting comparison in 96.
Yeah, I would agree. Last but not least, Wednesday, when the Fed cut rates, marked the first Fed rate cut in 30 plus years, with PCE inflation at or above 2.9%. So just as a reminder again for listeners, the PCE, or the Personal Consumption Expenditures Index, is a key measure of inflation in the U.S., and it tracks the prices of goods and services that households actually are buying, right? So it's a good gauge of consumer spending. So there you have it. Fed week, couple of nice facts for you all, and just a nice summary of what exactly happened. Before we move on, any other thoughts on what the Fed did?
I think that there was this expectation, it felt like, in the market leading into the announcement yesterday at 2 that it was going to be some sort of big buy the rumor, sell the news event. Meaning, for newer listeners, the market anticipated this rate cut the last several weeks, especially after Jackson Hole at the end of August. The market ran up into the announcement, and the expectation was, well, we got what we were expecting and no other surprises, so a bunch of selling coming into the market. And that really didn't happen.
Yeah, it did briefly during the day, but then the market bounced back very quickly.
Just interesting.
It is. And then, one other thing I will point out is that next week actually tends to be the weakest month of the year for stocks. So, again, there still is time for the market to sell off if it wants to.
Sure.
I'll go ahead and point that out. It's the week after quad witching for us investors. It means a whole slew of options contracts are expiring on this Friday, so tomorrow. And the week after that in September tends to be especially weak. Again, does not mean that it has to be negative this year.
A lot of repositioning over the next, especially tomorrow.
Yeah. So moving on to tweets, articles, research from this week. The first data point, or first thing that I had, was a data point from the Carson Group. It was a blog post by them on September 2nd. And Jenna will throw this chart up on the YouTube video. It'll also be in our show notes. But essentially what this chart shows, Matt, is the future performance of the S&P 500 after it was positive in May, June, July, and August. So each of those 4 months was positive, right?
Okay.
So the two interesting things that popped out to me in this chart was that the rest of the year averaged a gain of 3.5%. So that was from September through December.
Got it.
And markets were higher 76% of the time during that few month period. And the second thing that I gleaned from this is that the next 12 months averaged 9.3% and were higher 75% of the time. And this is data going all the way back since 1950. So I just thought it was interesting because, you know, there is that narrative in the market and in the mainstream media industry news headlines that, you know, you should be selling in May and going away. And if you did that this year, you would have missed out on a whole heck of a lot of upside.
Very correct. And I do feel at some point here, whether it is over the next month or some point over the next 6, you're probably going to have a month or two where you're going to have some weakness in the market, right? You're going to have some sort of pause or consolidation. And my word of wisdom, with all of my years of experience, is since we've been in this lower volatility environment the last 5, it will feel worse than it actually is. Does that make sense?
Yes.
Just be prepared. I don't know if it's going to be next month. I don't know if it's going to be for another 5, 6, or 7 months. At some point, we'll have a couple of months that might be a little nasty, and it'll feel worse.
Yeah. Agreed. Second thing I had was a post on X from Nate O'Brien on August 28th. It's kind of a fun one, Matt.
Oh, boy.
He says Build-A-Bear Workshop has outperformed pretty much every stock in the last 5 years, including Palantir and NVIDIA, which have obviously been some of the most high-flying stocks over the past few years. But over the past 5 years, Build-A-Bear Workshop up 2,561%. And, you know, it's trading at on August 28th, it was trading at $64.15. And, you know, over the past 5 years, it's gained $61.74 per share. I just thought that this was really interesting because I don't think Build-A-Bear would be in anybody's top 5, top 10, or even top 50 that they would guess were one of the top performing stocks. And I think it just goes to show you, again, I'm not very familiar with Build-A-Bear as a company, how they're doing financially, what their growth rates are, what's their revenue, what's their earnings per share. I don't track them very closely.
Yep.
But I think it just goes to show you how there can be differences in, you know, the quality or valuation of a company and then the quality and the valuation of that company's stock. They're not always the same.
Yes. Well said.
So
Well said.
I thought that was an interesting
That is an
one.
interesting observation and data point, I would argue.
Last thing I had was a quote from Peter Lynch. So Peter Lynch, again, famous money manager back in the day. He ran a Fidelity fund that did really well during his tenure there. And he says, I've never understood the apocalyptic theory of investing. If the world really does collapse, is it really going to do you any good to have a few Krugerrands in your pocket?
Ah, gold.
And yeah, for people that don't know what a Krugerrand is, it's a South African gold coin, right? So it was created to promote private ownership of gold and to help market, you know, South Africa's gold internationally, but you can sub Krugerrand for US dollar or Canadian loonies and toonies or whatever,
Yep.
right?
Yep.
The euro. So
Yep.
I really enjoyed reading this specific quote from Peter because it's something that at least I talk about with clients a lot during our meetings and, you know, preparing for Armageddon and preparing for the worst thing to happen. And again, if the world or this country is in a place where there is civil unrest all over the place. Some people might even call it a civil war. What happens if the U.S. Government defaults on its debt? What happens if World War III happens? What happens if the grid goes down? Go down the list of bad things that can happen. I think maybe not the last, but one of the first things that you worry about isn't going to be like, how much cash I have in my pocket or the investment portfolio, because that could be a time where that doesn't mean anything.
Yeah.
Does that make sense?
It does make sense. I mean, I'll take it right after 9/11. The market was closed for a solid week. For that week, it really didn't matter what was going on with investment portfolios.
Yeah.
And we knew a lot of selling pressure was going to come when it did open. I think that's just a prime example. And I like this quote because at the end of the day, I think so many people are preparing for something that has a low probability of occurring.
Yeah.
And if we just, we could drive home tonight and get in a car accident, but we still have to drive in a car to get places.
Right.
You can't mitigate all these risks and still get along with life.
Yeah, exactly. And I just think, there's probably going to be bigger concerns more than your investment portfolio or how much cash you have in the bank.
If an extreme event occurs.
Something, like you said, like that were to happen. So we wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock. But I will turn it over to you.
My first piece this week, Mark, has to do with a reminder for our listeners and viewers about not only the American consumer, but the importance of the higher end or the wealthier consumer. Mike Zaccardi, friend of the podcast, had a post on September 16th, Mark. And his post was in regards to the following. He showed a chart that illustrates that high-income Americans are behind roughly half of all U.S. consumer spending. That is up from about a third in the early 1990s. So I'll say it a different way. The top 10% of income earners in this nation do 50% of the consumer spending. That's important because when you look at the different, let's say, channels of the American consumer, there are definitely times throughout the last couple of decades where different segments of the American consumer were doing better than others. And with a lot of the inflation we've had over the past 5 years, I could argue, with data of course, that the lower end consumer has definitely been hurt a little bit more than the other consumer spending bands. With this piece of data, I just want to point out, I think there's a lot of positive things going right now for those top 10% income earners. And in my perspective, how I connect the dots, I think that's going to translate well to earnings of companies that cater to that demographic. That's the point. So when you see this data that Mike posted, the underlying source was Moody's Analytics. What's your thoughts that go through your mind?
Well, the first thing that came to my mind is how much do you have to earn to be considered in the top 10% of income earners in this country. So I'm going to look that up really quick, and I'd love to hear your guess.
So I'm going to throw out a guess on this. I'm going to guess 165.
165. Yeah, and I am using ChatGPT just to
Provide
put
the source
out there. Jenna, do you have a guess? To be in the top 10% of income earners, how much do you have to earn?
Per year?
Mm-hmm.
Jenna's thinking right now. She's off camera.
500,000.
Jenna threw out 500K.
So to be in the top 10% of income earners in the U.S., you need to make about $149,000 a year in wages. But if you're talking about household income, it's around $251,000 annually. So, yeah.
Interesting.
Yeah, very interesting. I think the other, thing that this makes me think about is, I think it's going to continue to be this way, and I'm going to explain this way. It would have to be a really, really poor economic environment, I think, for spending to start a new downtrend. Because if you have the top 10% of income earners spending 50% of everything in the economy, if we have a mild recession or a 20% pullback in the stock market, those spenders are probably not going to change their habits, right?
Keep going.
So it would take something a lot worse than that, or a lot worse than inflation at 4% for consumer spending
Habits
to decrease.
Yes.
And I think some people may look at that and say, well, that's not fair. It's really not representative of the American economy. But we also have to remember that, the American economy is completely consumption driven. So from that standpoint, I would argue that it is a positive that the top 10% of people make up 50% of the spending.
Yep.
Because it doesn't mean that the economy can't get weak, but it kind of puts somewhat of a floor, floating floor.
Well said.
Maybe on how worse or how bad things can get.
I think it's well said.
So
yeah, that's exactly the point I wanted to throw out there, and I think you just supported that perfectly. And we had not compared notes ahead of time. So my second thing has to do with gold. Okay, so gold's getting a lot of buzz. Another individual we reference a lot on the podcast, Charlie Bolello, had a post showing the annualized rates of return of gold going back to the early 70s. And Charlie had a post saying gold is on pace for its best year since 1979, up over 40% in 2025. Why am I highlighting this? We've had other periods of time where gold does really well and it becomes the in vogue investment on a temporary basis.
gold bugs.
Yeah, what comes reminiscent to me is the late 2000s during the GFC, right? It was a place to kind of hide out and it did well. So then, not too far in proximity date-wise, Barry Ritholtz had a post on X. And this is what Barry said. Here we go, ready? He was quoting Jim Reed from Deutsche Bank. Had you bought gold at its peak in 1980, you will only just have outperformed inflation today, 45 years later. By contrast, if you bought the S&P 500 index on that day, it would have provided you with a stunning 4,250% real return. However, had you bought gold in 2000, you would have comfortably outperformed the S&P 500 since. So here's my point. You will have times where certain asset classes in certain periods of time really shine. The attractiveness of stocks or equities is that they've consistently, over longer periods of time, provide a really good inflation hedge. Whereas things like gold and silver definitely have their day in the sunshine, but in my professional opinion, over long periods of time, have not posted the consistency that stocks have. Your thoughts on that?
Yeah, I think it's interesting that Yes, I would agree with that. Like commodities in general tend to be more cyclical in nature.
Well said.
Not as steady of an uptrend as stocks. And the other thing that this makes me think of is people could buy the same asset class at different points in time, say 10 or 15 years apart, and have two completely different experiences. I think it depends on when you are buying or selling an asset. For example, if someone graduated college and started in the markets in the mid to late 90s, they probably have a better view on the stock market or investing than someone that started in 2006, for example.
Yes.
Right? Same thing with Japan. If you bought Japanese stocks sometime within the past 10 years, you'd probably be pretty okay with that. But if you bought them in, the late 70s, early 80s, you're probably have a negative view of Japan because of how it's performed, right? So it really, I think there is a huge emphasis on the start date, regardless of what the asset class or the security is, because you could have two very, very different experiences.
You perfectly have discussed what my next piece is. Let's go right into this.
Okay.
And I want listeners and viewers to remember exactly what Mark just said there. So this piece was posted by a X account called Mr. Family Office. Okay. And he is
And for those that don't know what a family office is, can you just take 20 seconds, 30 seconds to explain it in your words?
So there are ultra high net worth families that can afford to have their own dedicated wealth managers, accountants, legal counsel, go down the line, concierge service that just services that extended family.
So it would be like us, for example, just servicing one family.
One family.
Yeah.
Okay. So this was referencing a Bank of America 2024 study on how generations rank investments. And it was only broken down to two groups, Mark. Ages 21 to 43, let's call that the younger generation in this example, and 44 years of age and above. And for the record, I made it by 1 year in the younger generation. What do you think about that, Jenna? Skin of my teeth on that one.
Nice.
So let's go over what they ranked as the greatest investment opportunities for growth on their segment of age.
Okay. Can I take a guess? I haven't looked down
please.
at it yet.
Please.
But so for the newbies, I think people put cryptocurrencies at number one.
Okay. Any other guesses?
2 U.S. stocks.
Okay.
3 real estate.
Okay.
Would be the top three.
I think those are some good guesses.
Okay.
And I would be very similar to you when I didn't see the data.
Okay.
How about for the older generation, 44 years of age and above?
Older generations, real estate number 1, U.S. stocks number 2, international stocks number 3.
Okay. Those are some good guesses, Jenna. Those are some good guesses. So here we go. Let's start with the younger generation. Okay. Here we go.
Really?
So
That's shocking.
real estate for the younger generation got number 1.
That's interesting. I wouldn't have guessed that.
I know. Do you feel it's just because of the gains we've had in real estate prices and it's now just appears to be a little more consistent to them? I don't know.
It could be, yeah,
Right?
and it could be for those people that answered here that they've been priced out of the market because it's been so expensive, and that's what they initially think of.
Right?
Yeah.
Number 2 is crypto and digital assets. Mark was spot on there. 3, private equity.
Wow.
That's interesting. I would argue most 21 to 43-year-olds wouldn't even afford the minimum investment into private equity.
Right.
Number 4, personal company or brand. I thought that was interesting. Number 5, direct investments into companies. Next, companies focused on positive impact. And the last two, bonds in dead last, U.S. stocks.
Wow.
That's,
So I think I had real estate in the, I had real estate and crypto in the top
stocks.
three, and I had stocks, which is dead last. Wow. Bonds, more so, are
more preferable than U.S. stocks.
Yeah, interesting.
And I think this is a component of what you were just talking about. And for me, has to do with GFC. The great financial crisis in the late 2000s was so emotionally jarring for multiple generations at that time that it's created such a negative recency bias. We could have similar types of market action in any of these areas at any time. But now we got the recency bias of U.S. stocks, in my opinion, really negatively affecting that younger generation. So now let's look at the other side of it. Let's look at the 44 and above, okay? Number one, U.S. stocks, they think is the most attractive from a growth opportunity. Number two, real estate. You're 2 for 2 right now.
Yeah, I am.
Number three, you're slightly off, barely.
Yeah.
Number three was emerging market equities, followed by number 4, international. So emerging markets for newer listeners, that's going to be smaller international countries.
Yeah, that aren't developed. Yeah.
Correct. Number 5, private equity. Next, direct investments into companies, bonds. Dead last is crypto and digital for that older generation.
Yeah.
I think it's just really interesting how stocks, number 1 for the older generation, dead last for the younger generation. Pretty stark results on that.
Yeah, I think it's very interesting. And again, this was in 2024 from Bank of America. But yeah, like we were just kind of summarizing, it just goes to show you how differently people's opinions or views can be based on their experience
and their starting time in doing it.
So yeah, very, very interesting. Be interested to see how, a similar survey like this would play out over the next 10, 15, 20 years and see what else is
sure,
going to come online, because it's, the asset classes that we have right now, I'm sure will grow over the next 20 years, right? Like
sure.
Digital assets weren't a thing 35 years ago.
Correct.
Right? So yeah, very, very interesting.
Yeah, I thought it'd be fun for a round
point.
table. As we get kind of near the end of the podcast, what else is on your mind, Mr. McEvely?
I don't think a whole lot. We talked about the Fed. It sounds like their goal is to cut 2 more times before the end of the year. And as a reminder, usually when the Fed cuts interest rates slowly, methodically, not doing emergency rate cuts, that tends to act as a tailwind for risk on assets such as stocks. So I think that is something that investors have the wind at their back in going into the end of the year.
Yep.
I've had a bunch of client review meetings over the past several weeks, and the one thing that I do point out is that 2026 is a midterm election year, and
it's true,
as we know and that we've talked about several times on here before. Out of the entire 4-year presidential cycle, midterm years tend to be the weakest year. Now, that doesn't mean that we're automatically going to get ultra-conservative in client accounts, but I think it's important to point that out and just know that going into the next year. Now, there's a lot of time between now and the midterms of 2026. We're still more than a year away, so
True.
There's a lot that can happen, but I think it's important for people to be aware of that.
My other thing that comes to mind as you were speaking, I agree with everything you said, by the way, and you articulated that very well for listeners and viewers. As interest rates continue to come down, again, I mentioned this on the podcast last week with Nick, I'm watching the longer end of the curve and how it's going to affect longer-term mortgage rates. And I'm still in this camp. No one's talking about it. Next couple of years, you're probably going to see a massive wave of refinancing. The average American who owns a home is going to be able to tap into these huge equity gains that they've seen in their property the last 5 years. And that, in my opinion, will fuel the next massive consumer spending cycle. They're going to pay off revolving debt. They're going to do home renovations, fill in the blank. No one's really talking about it. You'll start to see the headlines probably in the next couple of years, and you'll think back. I remember when Matt was talking about that in September of 2025.
Yeah. No, it's a good theory, a good prediction. So
We'll see.
I think people would be all for that. But if that's it, Matt, I just want to thank everyone for listening to episode 318 of the Independent Advisors podcast. We will be back with you next week for episode 139.
Take care, everyone.
Me,
339. We're fast forwarding. 319.
Yeah. We're wishing away time here. Have a good week, everybody.
Take care.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.